Hey everybody, Chris Englebert with Englebert Financial Advisers. What the heck is an IRA? I just want to do a little bit of housekeeping here at the beginning, just to let you know that anybody that signed up for the webinar, you don't have to worry about taking notes or anything like that because this webinar is being recorded and it will be sent to everybody that registered for the webinar. So just so you know, you don't have to take copious notes or anything like that. Just sit back and let the knowledge flow to you. The other thing we want to do is when we send you that link, excuse me, for the webinar, feel free to forward it to your friends and neighbors. There's obviously a lot of information out there and people need to really understand obviously how IRAs work. But more importantly, if you have kids 18 years old or older, feel free to send them this link because I know if they're like my son, he's constantly watching YouTube videos all the time. Excuse me again. And when he's watching his YouTube videos, this would be something good for a young person to watch. Now, the other thing I want to talk about is that this is just a basic overview of what IRAs are. This is not meant to be personalized advice. We always suggest to people that they talk to their CPA or their financial advisor. If you happen to be a client of Englebert Financial Advisers, obviously you might have heard us talk about some of these things in the past, so this is a good refresher course. Now, this is the second in our series of our summer school webinars. We're going to be doing another one in August, so stay tuned for that particular update. You're going to be getting emails. You're going to be able to click on a link and register for that one as well. But again, I want to get started here in a minute. Again, I'd like to thank the QCast crew for doing this. They always do a great job putting this together. So let's dive into what the heck is an IRA. So tell you a little bit about our firm first. We are what's called a registered investment advisor located in Allentown, Pennsylvania. We are different than a broker-dealer firm. And guess what? Next summer school series in August, we're going to be talking about the different types of advisors. So we're what's called a registered investment advisor. We happen to charge a fee to manage clients' accounts. If you have a $100,000 IRA, we custody at TD Ameritrade. We charge 1.25% to manage that particular IRA. And we have a lot of experience doing this. You can see from this slide that we have over 38 years of experience doing IRAs, defined benefit plans, 401ks, 457s. So we do a lot of retail business, which is obviously people like yourselves that may be watching this webinar. The other thing we do is we do a tremendous number of rollovers to an IRA, and you're going to see why in a minute, because just like all drains lead to the sea, everything eventually leads to an IRA. So let's talk about the purpose of this webinar. We're going to highlight a couple of topics. We're going to cover the basics of what an IRA is. We're going to talk about traditional versus Roth IRAs. Now, this is something that the media has kind of gotten out there, and people hear IRAs and they hear Roth IRAs, and there's this mystique or mysteriousness of why a Roth IRA can make you a millionaire. It can, but it's got to be used in the right way. We're also going to talk about what happens to your IRA when you retire. And unfortunately, we're going to talk about what happens to your IRA when you die. So what is an IRA? This is probably one of the most important slides in our presentation here because many times people have misconceptions about what an IRA is. An IRA is literally like an empty glass. Some people say, well, I have an IRA investment. I'm like, no, you have an IRA and you have investments that you put inside the IRA. IRA stands for Individual Retirement Account. It was brought out over 20 years ago as another way for people to save for retirement, because obviously 25 years ago, many companies were getting rid of their defined benefit plans and going to 401ks, and Congress decided that we needed something else, and they created the IRA out there, the Individual Retirement Account, which has been a huge advantage for many people for saving for retirement. Now, you got to understand there's tax advantages to putting money into an IRA. When I first started in this business, the amount of money that you could put in an IRA each year was only $2,000. Now, obviously, if you're under the age of 50, you can put $6,000 in. If you're over the age of 50, you can put $7,000 in. And wait until you see what's going to happen in 2023. We hear that they're going to up the amount that you can contribute to an IRA rather dramatically. So the other thing you got to understand about an IRA is that it's pre-tax money. anytime you can put money into an account that's pre-tax money, it's a huge advantage, because what ends up happening is you put $7,000 into an IRA, you invested in a mutual fund that invests in stocks, and it goes up to $14,000. You've just made $7,000 literally tax-free. So the big advantage of an IRA, it's before tax, so you get a tax deduction. So if you're making $70,000 a year and you put $7,000 into an IRA, you're going to see $63,000 as far as on your income taxes go, not on your W-2, that comes down to 401ks, but your accountant or whoever's preparing your taxes, make sure you let them know that I contributed to an IRA. Now, again, this is intended to be a long-term investment account, is really what it's intended for. Now, some of the advantages of the IRA, like you heard me talk about, is that if you are in a 401k, 403b, or 457 account, you've got to put money in through payroll deduction throughout the year. The great thing about an IRA is that when you go to get your taxes done, and we say this over and over and over again to people, have your accountant run the numbers and say, what happens to my tax situation if I throw $2,000, $5,000, $6,000, $7,000 in an IRA? And he'll be like, well, you're going to save $2,000 or $3,000 in taxes. So remember, it's better to write a check out and make a contribution to an IRA than it is to write a check out and make a contribution to Uncle Sam. So the cool thing about an IRA is you have up until April 15th to make that contribution to an IRA, so you can kind of play around with the numbers and see how much you can put in an IRA and how advantageous it is for you. Now, remember, there are different types of IRAs. We're covering the basics here. We're going to talk about traditional IRA and a Roth IRA, but there's some really cool things you can do if you're self-employed with what they call a simple or a SEP IRA, but that's beyond the scope of this presentation today. So let's talk about traditional versus Roth. I'm going to bust some myths here. The internet, is a great thing to learn information on, but it also has a lot of myths going on. Like I said previously, you're funding an IRA with pre-tax dollars. That's a traditional IRA. A Roth IRA came to be, and that is funded with after-tax dollars. So basically what ends up happening is you pay taxes and then you fund a Roth IRA. So again, you got to be a little careful, because you can see that the advantage of an IRA is that the contributions are tax deductible, while in a Roth IRA, they are not tax deductible. However, if you look at the withdrawals in a Roth IRA, at some point down the road, you take those withdrawals out tax-free. Now, we also have some things that we talk to people about when they should do an IRA and when they should do a Roth IRA. And you can see on the right side of my screen here, I talk about the 25 and 25 rule. What do I mean by that? If you're less than 25 years of age, making less than $25,000 a year, you should do a Roth IRA, because your tax bracket is so low that it's more advantageous to do a Roth IRA. You're in the 10, maybe even the 15% tax bracket. So go ahead and do a Roth IRA. And if you have a 401k, you might want to do the Roth 401k as well. However, once your income starts going up, you're going to be wanting to take advantage of either the 401k at your company or a regular IRA. And some things to remember, and I see this happen all the time. I'll have a couple in, and they'll come in, husband and wife, and they're like, oh, we don't put any money in our 401k, we throw it into an IRA. Well, you can see that the deductibility for IRAs, and this is an important point to remember, that if your gross income between husband and wife is over $204,000, you began to lose the deductibility of an IRA. You can't deduct the full $6,000 that you throw into an IRA. That's where your 401k, 457, or 403b come in, because they have no income limits for the deductibility. You can see that for a regular IRA, if you make over $129,000 as a single person, you began to lose the deductibility of a traditional IRA. So again, make sure you understand the limits as far as income limits, as far as what you can do by putting money in an IRA. And it's the same thing with the Roth too, is that you can't, if you're husband and wife and you make over $204,000, you can't do a Roth IRA. You could do a Roth 401k, 457 or 403b. We don't know why you'd want to do that, because again, you're in a much higher tax bracket, but you're not limited by income limits as far as what happens with a Roth IRA. So the good news is, that for most people, if they don't hit those income limits, they can still do an IRA. The bad news is if you hit those income limits, you really can't do an IRA, and you got to take advantage of your 401k, 457, or 403b. Now, all bets are off if you're self-employed. You fall into a different category where if you're self-employed, you can do a one-person 401k or a SEP IRA. But again, that's beyond the scope of this presentation. Now, let's talk about an IRA. What happens when you go to withdrawal? As far as your IRA goes, what happens is withdrawals are taxed as ordinary income. So let's say you make it to age 62 and you decide to retire and you're no longer working and you have this IRA that you want to take withdrawals from. You got to remember that any money that you take out of your IRA is taxed as ordinary income. So if you take $10,000 out of your IRA, it looks as though you made an additional $10,000. So you have to be careful about how you take your money out of your IRA, because obviously you're going to pay income tax on it. Now, you could have income tax withheld from your IRA as well, if you need to. So for example, in our shop here, we have clients that have an IRA. We hook it up to their local checking account, and they'll call up and say, I need $1,000 from my IRA. Can you do a 15 or 20% tax withholding? Absolutely. We send that money to the IRS. You then get the benefit of the rest of that money. So it's very easy to set that up with the different financial institutions. The other thing you got to remember about an IRA is that if you take out money before age 59 and a half, and again, this is why it's designed as a retirement program. If you take out before age 59 and a half, there's a 10% early withdrawal penalty. So sometimes we have people that are 40 years old and they call up and they say, hey, I'm having a hardship situation. I need to take some money out of my IRA. What should I do? And we're like, the IRA is probably the worst place you want to take it out of, just because you're not only going to pay taxes on it, but you're going to pay a 10% penalty as well. If you need the money, you need the money. But again, you got to understand how that works. IRAs are really designed for savings as far as retirement goes. So the other thing you have to do is you have to take a required minimum distribution at age 72. So at age 72, if you haven't taken any money out of your IRA, every year it's calculated about 6% the first year on whatever the balance is of your IRA. That's got to be taken out sometime during the year. And so that's how RMDs work, or what they call required minimum distributions. So let's talk about the Roth IRAs a little bit. Obviously, why people sometimes get the misconception that Roth IRAs are better is that when you take money out of a Roth IRA, you do not have to pay any taxes on taking that money out of a Roth IRA. So Roth IRAs are good in certain circumstances. If you're very young, you want to contribute to a Roth IRA. But one of the strategies that we do with clients is they'll have a traditional IRA. They'll be 66, 67, 68 years old. And we'll talk to them about doing a conversion to a Roth IRA of some of their money. Now, we're getting a little advanced here, but what we mean by that is that at age 72, you've got to take the money out of your IRA according to your required minimum distribution. If you convert some of the money from a traditional IRA to a Roth, you will pay the taxes, but now you've converted the money to a tax-free Roth account and never have to pay taxes on that again. That's something called a backdoor Roth. And if you're in a situation with a rather large IRA, make sure you contact somebody like myself or your CPA to talk about what happens by doing a Roth conversion on your IRA. So these are some of the tips and tricks that we talk with clients about all the time. And it's the reason why you want to work with a CPA or financial advisor, because we do strategy planning with IRAs all the time. Now, I want to get back to when you want to use an IRA, because somebody may be saying to me, hey, Chris, you know what? I'm working, my company's got a 401k, but I don't want to be part of the 401k. Or for example, if you're a teacher, a younger teacher, you may have a 403b, which is not run very well, or it's very difficult to get signed up for the 403b. Then you got to consider using an IRA. So if your joint income between husband and wife is at the point where you can do a traditional IRA, open an IRA account, hook it up to your checking account. And what we can do is we can actually take money every month out of the checking account and fund the IRA. Now, the important thing to remember is also remember that you got to let your accountant or whoever is doing your taxes know that you made contributions to an IRA throughout the year so that they deduct that from your income tax. But we see many times where people don't want to get involved in their 401k, 457, or 403b because they're just starting out in the workforce, or it's difficult to sign up. And we say, open a traditional IRA, fund that as you go. But then at some point in time, when your income gets high enough, you may have to switch over to your company's 401k, 403b, or 457 to get that additional tax savings. And what do I mean by that? Like I said, IRAs, if you're under the age of 50, you can only put $6,000 in. A 401k, 403b, or 457, you can put $20,500 in if you're under the age of 50. So if you're trying to jam more money in for retirement, you may have to then look at your company or wherever you work, the 401k, 403b, or 457. But if you're starting out and you want to put at least some money away, an IRA may be a good place to do it. And if you're really young and the place you work for doesn't have a Roth option, like I said, you're under the age of 25, making less than $25,000 a year, you might want to open a Roth IRA. For example, if you're taking a temporary job for a year or two, you may not want to be involved in that company's retirement plan unless they do a company match, but that's another story. So there are times when you want to open a traditional IRA, and times when you want to get involved in your whatever entity you're working for, the retirement plan. So again, talk to your accountant, talk to somebody like ourselves, and we'll tell you, hey, this makes more sense. If you're only going to be putting in $5,000, $6,000, $7,000 a year, it might make more sense to do an IRA than get involved with a plan that has a limited menu, has higher investment options, et cetera. Because like I said at the beginning of this talk, an IRA is like an empty glass. You can literally put any type of investment, almost any type of investment in there, inside your IRA. So you can put individual stocks, individual bonds, bank CDs, et cetera. And many times a 401k, 457, or 403b has limited investment options that you can choose from. So if you want to do something different with your IRA, that may be a reason why you want to have an IRA. So what happens is, how do people get these gigantic IRAs? Well, obviously they make contributions to them over time, and the sooner you start, the better. But the other thing that happens is that when you leave your job, don't leave your 401k, 457, or 403b behind. Now, many times, if you have a 401k at one company and you go to another company, you can transfer the 401k from one company to another. Not a bad idea. Again, we've done webinars on this and why you want to look at your options doing that. But what many people do is they roll that money over to an IRA. Because again, just like all drains lead to the sea, everything eventually leads to an IRA. So we've had people that over a 10, 12, 13 year period of time have had several different jobs. And rather than move a 401k to another 401k, they've just moved the money to an IRA because they wanted a wider investment selection. Now, you also have to take in consideration what the fees are by doing that, and what the fees are you're going to be charged by being in a 401k versus a IRA, et cetera. Those are something very important that you have to examine and you have to talk about. So what happens when you retire? I've given you a little precursor to this. Many times people roll over to an IRA is what they end up doing. Again, you can do practically limitless options as far as how you want to have your money invested. Maybe you have a $300,000 rollover and you want $100,000 really safe in bank CDs. You want another $100,000 in dividend paying stocks. You want another $100,000 in more aggressive investments. You can do that in an IRA. It can also be much more cost effective by doing that, because many times the closer you get to the actual investment, like owning a stock, the less expensive it is in the long run. You also have greater control over your withdrawals. Like I said, at our practice here, we have people that have IRAs and they've set that up to supplement their ordinary income, where we send a check out monthly, quarterly, once a year, however they want it. It just has a lot more flexibility by rolling your money over to an IRA versus leaving it behind in a company plan like a 401k, 403b, or 457. So the dollars also follow their own path. And what do we mean by that? If you were doing a pre-tax 401k, 403b, or 457, that pre-tax money is going to roll over to an IRA. If you were doing the Roth option in a 401k, 457, or 403b, that Roth option is going to roll over to a Roth IRA. You got to make sure that you understand the two different courses of action. You also have to engage with a professional. I would strongly recommend if you get to the point where you're retiring, you talk to a advisor, obviously like ourselves, or your CPA about, hey, I'm leaving this company. Here's the size of my rollover. What should I do? 99 times out of 100, they will tell you to roll that over to an IRA, because if you would take a distribution, you would pay a tremendous amount of money in taxes. So remember, when you leave a company and you roll your money over, it's not a taxable event. You roll over from your 401k, 403b, or 457 to an IRA, you pay no taxes on that particular rollover. When you go to take your money out of an IRA, that's where you're going to end up paying taxes. Now, there's a lot of pitfalls to avoid. And unfortunately, there's many investment firms that kind of prey on people because, for example, we do IRAs all the time. We know them inside and out. We know how they work. We know how they operate. We know how to set up an IRA. So what ends up happening, though, is many times people will leave a school district, a police force, or a company with a 401k, and they'll be like, I have no idea what to do. And somebody will approach them and say, hey, listen, my buddy works at this particular investment company, and we'll get you set up. Make sure you tune, and this is a commercial for our next webinar in August. Make sure you tune into our August webinar, because we are going to talk about how everyone gets paid in the investment world. And I started out by saying that as a registered investment advisor, we charge a fee to manage an account. We don't charge commissions up front. We don't charge commissions out the back. We don't charge commissions during transactions. We charge an investment advisory fee that as your account gets bigger, as you do better, we do better. You've got to be careful, because many times there are advisors out there where they suggest different investment products to put inside of an IRA. My biggest pet peeve, and we've done a couple of promos on this. You can get on our website and look for some of our Englebert Angles. That's a weekly video that we do where I talk about beware of putting a tax-deferred annuity inside of an IRA. Tax-deferred annuity is a tax-deferred account. The question is, why are people putting it inside of already a tax-deferred account, which is an IRA? The number one reason is commissions. Many of these tax-deferred annuities have commissions of anywhere from 8 to 15% up front. So if you're rolling over a $100,000 401k plan to an IRA, you could pay $8,000 to $15,000 in commission up front when you do that rollover. So always ask questions. If somebody says to you, if an advisor is not candid and says to you, here's how much we're going to charge to manage your IRA, or they say the other thing that really grinds my gears, oh, don't worry about the fees, it's taken off the top and you get what's left over, I would walk away. They should be able to tell you, just like I did at the beginning of this webinar, that we charge 1.25% on a $100,000 account. So we charge about $1,250 a year. We bill it quarterly, which works out to be about $300 a quarter. And that's what we charge to manage. If they can't tell you that there's a front-end sales charge, a back-end sales charge where they're getting a commission, it's obviously unethical. Now, we're going to get to a little bit more serious note here. What happens to your IRA when you die? A couple of different courses of action that happen. So obviously, if you're married, husband and wife, and you leave each other as beneficiary, there is no taxable implications. If the husband has a $100,000 IRA and the wife has a $100,000 IRA and the husband passes away, the wife can just roll that IRA over and have a $200,000 IRA in her name. That's how it works between spouses. But the big thing you have to learn is what happens if you pass away and you have a non-spouse as beneficiary. Then you get something called an inherited IRA. So this inherited IRA gets set up. So let's say, for example, the husband and wife, the husband passes away, the wife has the $200,000 in an IRA. She then has two sons that she names as beneficiary. The wife then passes away. Each of those two sons, depending upon how she split the money up, if she split it up 50-50, each of those two sons would get a $100,000 inherited IRA. Now, there's been some rule changes as far as what happens to inherited IRAs over the last couple of years. And what ends up happening is that you can see by our third bullet point is the Secure Act of 2019 says that the entire balance has to be withdrawn within a 10-year period of time. There are some exceptions to that, but using my example of the husband and wife, the husband passes away, the wife gets, the IRA, so she has 200,000. She then leaves 100,000 to each of her sons. Her sons now have 10 years to take that money out of the IRA. So we do strategy planning all the time. Let's say the sons are 45 years old, they're working, they got a good career. They can either take all the money out at once and pay the taxes, or they can take it out over a 10-year period of time, or they can wait until they retire and then begin to take it out in bigger chunks during that period of time. So again, if you get an inherited IRA, you've got to talk to a tax advisor or a financial advisor like ourselves who understand how these things operate. For example, I had a woman whose mother died and she ended up getting an inherited IRA. And in this particular case, she was taking money out every year. She had to because the mom was already taking her required minimum distribution when she died. And so the daughter had to continue to take the required minimum distribution as well. So what we did is the daughter, I mean, obviously everybody needs income, but there's tax ramifications because the daughter had a good job and this was going to add additionally as far as her taxable income goes. Well, what we did is we jacked up her 401k contribution. So she had to take out about $10,000 from this inherited IRA every year. Well, what we did is we jacked up her 401k contributions by $10,000. So her total income looked about the same from a taxable standpoint. So basically, you were washing the taxable inherited IRA money by making a contribution to a 401k. This is something that we do all the time. And again, if you are the beneficiary of an inherited IRA, make sure you have a strategy so you understand how these inherited IRAs work. If you have any questions, we could take some questions right now. Or if people would want to, you can email us. You can email us our questions. A lot of times people don't want to ask questions in a format such as this. So feel free to email us. You can email me at chris@englebertfa.com. That's CHRIS at Englebert, ENGLEBERTFA.com. And you can ask me a question there. The other thing that you can do is that you can follow me on Twitter at CEngelbertRIA, Facebook, Englebert RIA as well. The other thing you can do, this is a big push that we have, is we have an app. And so you can download my app by texting Chris E, CHRISE to 36260. Then you'll have my app on your phone. It's a great way to contact us. You'll have our office number, my cell phone number. You'll be able to email me. We have a lot of video content on there as well. So that's what we hope we accomplished today, is explain to people, what the heck an IRA is, so that they understood, from that standpoint. Oh, we got one question before we finish here. I want to go back in my slides here and talk about required minimum distribution. So I talked about that at age 72, you have a required minimum distribution, which works out about the first year to be about 6%. It goes up every single year. So for example, if you have a $100,000 IRA and you're age 72, you're going to have to take out about $6,000 the first year for your required minimum distribution. Now, if you are somebody that likes to give to charity and you're writing a check out of your checking account to give to charity, stop. Because if you have an RMD, what we can do, and any institution that has IRAs can do, is that if you take a portion of your RMD, some of it, all of it, whatever you want to do, how generous you feel, and you give it directly to that institution, you then don't pay taxes on the amount of money that you gave. So for example, if your RMD, required minimum distribution, is $6,000 and you give $2,000 to, it's got to be a legitimate charitable organization. It can't be something made up. It's got to have an EIN number, 5013C corporation. And all these charitable organizations know about required minimum distributions now. So let's say, for example, it's your church. You can request us to send a check directly to you that's made to the benefit of your church or the YMCA or whoever you give your money to. And you can hand deliver that check. You can make it anonymous, whatever you want to do. But then at the end of the year, when you get your 1099-R, you're going to see that, yes, your RMD was $6,000, but because you gave $2,000 to a charitable institution, the amount that you include for income on your taxes is only $4,000. It is the best way to give money going forward by using your RMD. So rather than just writing a check out from your checking account, use your RMD to make contributions to charitable organizations. It'll help you from a tax standpoint. So again, appreciate the question. Again, what we're going to do is make this webinar available as a link so that people can watch it back later and pick up some of the things that we talked about. If you have a personal situation that you want to discuss, feel free to email or call us and we'll take care of it. But again, we'd like to thank everybody for being part of the summer school webinar series. Stay tuned for August when we do our next one. And we hope everybody has a great time and we'll talk to you soon.